Hello, everyone. Thanks again for joining us today. Just as a reminder, I'm Haydon, the founder of Good Green Money. We're an ethical IFA firm, and part of our remit, clients come to us, we give them good financial advice, and often we'll build portfolios for them. And when we're building these portfolios, we look for the best ethical, responsible funds out there. Today, I'm talking to Jamie from Columbia Threadneedle, and the fund that he looks after is one of the best out there. How are you doing, Jamie?
Very well. Nice to see you today, Haydon.
And you? Well, come on to have our conversation in a moment. Just let me set a little bit of background here. Now, if anyone's watched the video that I did with CT, Columbia Threadneedle, recently with Jamie's colleague, Catherine Stanley, I explained a bit about who Columbia Threadneedle were there, so I won't go into great detail now. I wouldn't say they're a major US investment house, and they've got a strong interest in investing ethically. In terms of this fund, the CT Responsible Global Equity Fund, this runs alongside Catherine's fund, which was UK based. This is a global fund, so Jamie and his colleagues can, as it suggests, invest anywhere in the world. It's an equity fund, so invest directly in stocks and shares of businesses. It's run by co-managers Nick Henderson, Jamie Jenkins. The CT Responsible Global Equity Fund, it actually started life. It's one of the stalwarts. It's one of the beginners of the ethical investment mix that we know today. Started life as the FB Stewardship North American Fund. It's had various iterations since then. It's now had a change of remit in 1998 to become a global fund. And it's moved through to become the F&C Responsible Global Equity Fund, BMO Responsible Global Equity Fund, and as we know it today, the CT Responsible Global Equity Fund. It's worth over £1.5 billion, so it's got some bite to it, investing about 50 stocks. Today, as I say, I'm talking to Jamie Jenkins. Jamie is Columbia Threadneedle's Managing Director and Head of Global ESG Equities, so he's a perfect man for me to talk to today because he will know his stuff inside and out. And right, we'll get talking a bit technical now, diving into the fund so we learn more about it. When I spoke to Catherine, one of CT's approaches is their avoid, invest, improve strategy. Excellent strategy. We went into that into some detail. Today, Jamie, I'm going to concentrate on something else to start with. You've got a fantastic and responsible investment team there, and you have an ESG process, environment, social, and governance process, which you embed in what you do. Tell me more about that process, the stage you should go through. I'd be really interested to learn about it.
Okay, yeah. Well, thanks, everyone. Great to speak to you today. So the Responsible Global Equity Fund has a very consistent, very simple process. It's really a 5-step process. But you shouldn't think about this as a kind of conventional global fund with a light ESG overlay. Instead, think about it as being highly considered, highly ESG integrated. It's intended to be a very specialist fund that does embed environmental, social, and governance considerations right the way through the investment process. I mean, the first step of an investment process, our investment process, is idea generation. Now, that ideas can come from a number of different areas. It can come from one-on-one meetings, group meetings, attending conferences, reading interesting bits of research, or indeed just the paper. Now, we consider that our investment universe starts out being roughly around 5,000 companies in size. That's principally large developed market stocks. And it's very much the remit of the analysts and the portfolio managers on the team to generate ideas. However, because this is a specialist ethical fund as well as a responsible fund, we do screen the universe down. We apply very comprehensive ethical and sustainability criteria against the wider universe of companies. And so after these screens have been applied, we think our addressable global universe is reduced to around 1,000 companies. Now, you might say that's quite a radical reduction in number, but not once in the 10 years that I've been managing this fund have I felt constrained by these screens. Now, these screens are, some of the traditional sort of sin sector screens you'd expect a fund such as this to exclude. So we're talking weapons, tobacco, gambling, pornography, fossil fuels. Our fund has been fossil fuel free since Q1 2016. And so we consider the screens to really actually be very enhancing to our ultimate performance outcome, because a lot of risk, both from an ethical and sustainable perspective, are removed. And invariably, these type of companies that get screened out also carry quite a lot of balance sheet risk. And so we are investing in a higher quality, higher sustainability minded footprint of universe of companies. And when you're only running a portfolio of around 50 companies, if you've got 950 other high quality alternatives on the bench, that's plenty. And of course, we're always refreshing that bench with new ideas. After the screens have been applied, we're at the second stage, and there we work very closely with our responsible investment colleagues. We then go forward to full detailed company analysis. We write very detailed research. Every member of the team is a research writing member of that process. We look for companies that really have a healthy balance of opportunity and risk in what they do. We're looking for high quality businesses with strong management at an attractive price. I mean, it really is as simple as that. We write research notes. We debate them at our 2 research meetings of the week. We have a very vigorous process of team challenge. Assuming a company is agreed to be a good idea, we think the thesis stands up, we think we've got a 5+ year horizon to the investment proposition, then Nick and I and other select members of the team will take it forward to a portfolio construction discussion where we think about what does it bring to the fund, how is it going to fit in alongside existing names, what names might we remove because this is a superior idea. And so, that's where we think about the impact on the risk profile of the fund, what weights would be appropriate. Assuming the company comes into the portfolio, we'll then think about a very detailed active ownership agenda. How are we going to try and engage with the company management to enhance the thesis, enhance the appeal of the business? And as many of you will hopefully be familiar, we try and be very transparent. We try and commit to our investor base to be transparent in our communications. And one of the ways which we do that is through our annual ESG profile and impact report, which I think hopefully gives a great insight into not just the underlying holdings in the fund, but also the whole rationale for them and the various engagement interactions that we've had over the 12 months in question. So that's it really. Idea generation, screening, company analysis, portfolio construction, then active ownership and reporting.
Thank you, Jamie. That is excellent. That's very, very thorough. Just to re-emphasize some of the points that Jamie's making there, the fact that they cut down their universe by 80% is an impressive thing to see when you're looking at these funds from the perspective of somebody such as myself and my company, where you see companies with, as Jamie said, very light ESG screen. They might strip out 5-10% of the market. They're really not doing their job properly. So still got a decent sized investable market there, but they do remove a lot of businesses based upon very specific criteria. One thing I will just pick up on, you spoke about balance sheet risk is something that you can embrace. For anyone that doesn't know that, you can, as an investment manager, look for companies that have got very strong holdings of cash in the bank and that type of stuff, low level of competitors, a bit of a monopoly. The problem with that is that it can constrain what you do if you focus on those type of areas. So to move away from that, but still look for companies which have got really good, attractive propositions and strong management in other ways is a great methodology to work by. So ultimately we started off with 5,000 or so stocks, get down to the 50 in there. That's 99% of the market gone. So that's a fantastic overlay there of a really stringent ESG process. Jamie, I want to move on now because something that's evolved in the ethical space rightly so, over the last X amount of years, is a stronger and stronger focus on things that are environmental and the critical importance of it. And we all see every day the impact of climate change. It's horrendous, and we have to do what we can to fight it. And you're doing your piece, I'm doing mine. I pick up on this because I know that you have a means, a methodology, another process that you use to assess net zero of the companies that you invest in. Talk me through that, about your net zero alignment process and why that's important, what you do.
Okay, yeah, well, absolutely. It's a vital interest area for us. A lot of our engagement activity has been focused around climate change in the last couple of years, and it's likely to be going forward. Clearly, it's becoming a greater concern for the world. And Columbia Threadneedle is one of the signatories to the Net Zero Asset Management Initiative framework. And with our one of the great advantages of the recent integration between BMO GAM and Columbia Threadneedle is that we have increased our resources around the responsible investing space. We now, on a combined basis, we had 45 ESG research colleagues. That's actually in the process of being expanded out to 60 over the next 12 months. Within that, we have a number of the team who are absolute climate and environmental specialists, and so they work very closely with the likes of myself and Catherine to assess the net zero risk. One of the things we've done is create a net zero asset level alignment framework. It's basically a simple, well, relatively simple, 8-metric checklist for which we assess any given company in the portfolio. So we go through 8 different, we look at 8 different measures to see where a company stacks up in terms of its net zero journey. The first one is around its commitment. Has it got a stated ambition to reach net zero emissions or not? And does that cover scope 3 as well as scope 1 and scope 2 emissions? Has a company set any interim targets? That's step 2. Are these targets aligned with a 1.5 degree trajectory as mandated by the Paris Agreement? That's step 3. In terms of step 4, we look at their disclosure. Do they disclose their scope 1 and scope 2 emissions? Have they got the intention to disclose scope 3 as well? We don't understandably, these companies are on a journey, so we don't expect them to be able to do all of this right from now, but we need to see that commitment. The 5th one is, does the company have a credible strategy in place to achieve net zero? What kind of lobbying? The sixth item is around policy and engagement. What kind of policy is in place for the company to align to net zero emissions? The 7th aspect is around governance. We want to see appropriate board level oversight of the climate strategy. So increasingly, we are expecting board members to have climate knowledge. We need to see the board with the appropriate skill set. And also, ideally, we'd like to see executive pay linked to climate change targets as well. And then, lastly, the 8th level of the alignment measuring is around climate risk and accounts. We want to assess whether a company is signed up to the TCFD. Are they disclosing within that framework? And so it's important for us as a company to assess net zero when we're looking at companies, but it's an important component of our fundamental research process, because the net zero status of a company makes a difference to our valuation. So it's fully this assessment of net zero is not just a kind of top level measurement. We actually integrate this down into the valuation work we do, and that helps us generate hopefully more ESG integrated price targets for the companies we like to invest in.
Again, thank you, Jamie. That's very thorough. the fact that you are taking that into consideration of the valuation is I think it's imperative. It's going to become more important going forward. And in terms of making a cultural shift within a business, I'm really pleased to see that you are pushing to link this stuff to executive pay. I think something I thought should be in place long before now, and governance as well. So those things at board level are what will push this through the makings of businesses of all types. So that is great to see. Just one point to clarify in case anyone's not familiar with this, scope 1, 2, and 3, you probably are if you're watching this, but if you're not, this is all about the amount of CO2 that you use as a business at different stages. So scope 1 is, you're a manufacturer, it's the raw materials you use. Scope 2 is a little bit wider in terms of resources that you bring in. Scope 3 is the one that businesses find it difficult to measure, but it's becoming easier. It's about the knock-on effect of the third parties themselves that you, so supplier that you bring in, have they measured their input? Now, this will get easier over time because as every business does its piece to assess what it does, then when it's passing on information to others, that'll become more measurable. But the fact that you've drilled down into that and you're doing what you can to pull through the scope 3 stuff is, again, something that's great to see. It's going to come more to the fore. Okay, another area, nuance that's come out of ethical investing in recent years, and something that's very important, is the idea of impact investment. Let's not steal your thunder. Tell me more about impact investing and the process that you go through and why this is important as well.
Well, thanks for the question, Haydon. I think if you think about sort of coming trends around ethical and sustainable investing, I think impact is becoming probably the hottest buzzword. I think impact has historically been associated with the unlisted investment fields, areas like private equity, maybe real estate, where it's easier to attribute the impact of your investment with a particular outcome. I think it's a little bit more complicated in listed equities because you are not the only investor that you are advocating for change. You're not the only investor trying to deliver a positive non-financial outcome. But just because it's difficult doesn't mean that we shouldn't be thinking about this, because I think if we are going to change the world around us for the better and deliver a highly competitive investment return for our investors, it's valid to discuss impact in listed equities. And so we've started to establish a framework for impact. Just to be clear, Responsible Global Equity Fund is not an impact fund, but we are thinking of the fund having something of a dual mandate. We are trying to deliver that investment return, which is highly attractive, but we're also trying to push for positive non-financial outcomes. And that's something that we report on in our annual impact report. There are really 4 components to our thinking around impact. Now, the 4 words are additionality, intentionality, materiality, and measurability. I'll briefly go through each one. In terms of additionality, the first aspect, here we're thinking about that there are 2 components to impact. What does the company do? What is its product and service, and what is its impact on the world? So that's what we call enterprise impact from the company itself. But because we've always believed in being a highly engaged investor, one that's trying to promote active ownership and a deeper conversation with companies, we also think it's valid to talk about investor impact. What is the investor contribution that we can make to driving the non-financial agenda? So those are the 2 components that we think about in terms of additionality. In terms of intentionality, we want to see companies that are highly intentional in how they are running their strategy, how they are allocating capital across their business range. And so, looking at things like their R&D budgets, looking what projects they are financing, allows us to assess how intentional a company's impact can be. The third component is materiality. We obviously want to assess how important is this impactful business to the company itself. So we look at how big this business division's revenue is within the context of the entire turnover of the business. And of course, there's a kind of spectrum of materiality, and then there's a bit of a judgment call about whether, a business could have a very small revenue contribution, but it could be hugely impactful versus a huge chunk of their revenues, which has a much lighter impact. So, it's kind of shades of grey, but it prompts a very detailed conversation amongst the team when we're researching ideas and promoting new ideas about where does this company sit on the kind of impact spectrum. And then, of course, we're trying to, as you'll see from our impact reports, we're trying to report back on the difference these companies are making. We're looking for specific, measurable, achievable, realistic, and time-bound outcomes. We call these SMART outcomes. And, we do endeavour to report on these non-financial outcomes that companies are having. They could be different for different sectors. They can be different for different parts of the world. But we think this is an interesting, thoughtful area for the market to be expanding into. And responsible global equity absolutely has a role to play in delivering this kind of ambitious twin mandate to deliver an attractive financial return and encourage and enhance positive non-financial outcomes.
Thanks, Jamie. That you've clarified that very well. I mean, as you emphasised at the start, this is more of an ESG overall generic fund. There are specific impact funds out there that concentrate doing just this. This isn't one of them, and you can't fill a portfolio, from my perspective, just of impact funds. It's really important that you include really decent, high-level ESG funds such as this one. And but it's great to see that you are going into this level of detail. As you mentioned earlier, transparency is key to what you do, and to report this stuff. Anyone that cares about this will pick up on the stuff that you're sharing with us. So fantastic to see. Right, I think we've gone into a lot of detail about the mechanics and the theory here. I think it'd be quite useful if we can dive into some examples. A general approach that I try to use where I can is to look at an example of a company that's going to be positive towards the planet, so environmentally positive company, one that's more people orientated, and then ideally one that sort of crosses both bridges. We've highlighted a couple of some examples here, so maybe if we just dive in, you tell me about the first one. It's Xylem, spelled XYLEM, for anyone that's watching this. Tell me about Xylem and why they're in your portfolio.
Okay, so Xylem's a fascinating company. It absolutely plays right into that planet concept. So it is, we think, probably the world's most water-focused industrial. It's a US listed company, mid-teens $billion market cap. It's a designer, manufacturer, and service provider for water and wastewater applications. It looks at the whole full life cycle of water. And we live in a world where, sadly, we have too much water where we don't want it, in terms of increasing flooding crises, and also we live in a sort of very drought-prone world. And Xylem produces the equipment to water municipalities, to large utility companies, as well as the monitoring equipment that allows companies to deliver potable, healthy, safe water to people all around the world. They are a US listed company. They are very focused on, in the developed world, particularly the US and Europe, we've got a lot of aging infrastructure. We have a lot of leakage from water services. And so these guys can help analyze where the leaks are. They can help water treatment and help the sort of the monitoring of quality and leak detection. So fantastic business. And we're confident that water spending over the next 5 years is going to outstrip GDP. It's an absolute vital area for investment. But not only do they service developed economies, but they also see a really big greenfield opportunity in emerging markets, where still, millions of people around the world have no access to drinking water, safe drinking water. They have local brands, local manufacturing for Asia, for Africa, for South America. And they also provide like the world's highest output flood remediation pumps. So, when you have heavy flooding in all sorts of parts of the world, they can go in with these heavy bits of equipment and start pumping water out in terms of flood remediation. So fascinating company. We've got to know them really well. You might think through lockdown it's more difficult to speak to management, but one of the advantages of lockdown was that we knew management were at home. We had some fantastic conversations with them, and Xylem we think is a company to be really constantly really focused on, and it's really linked into that Sustainable Development Goal 6, which is around clean water and sanitation. And I think most people could buy into the idea that water is a vital, basic necessity that we need more companies working on.
Fantastic. You've run through that in great detail there. Anyone that's watching this, again, Sustainable Development Goals, you'll know probably what they are. If you don't, there's a section on our website and you'll see it all explained there, and we run through all of them, all 17 of them. Fantastic. We move on to a second example. This is more about people, socially positive. And this example, Hoya, H-O-Y-A. Tell me about them. But also, you mentioned earlier active engagement. Any decent ESG fund is very involved in active engagement, and I know that you've engaged with these guys. So, tell me a bit about Hoya and what you've been up to.
Okay, well, in a nutshell, so Hoya is a Japanese company. It has two main business lines. It's the world's second largest manufacturer of eyeglass lenses for spectacles, behind the company EssilorLuxottica. It also does contact lenses. Its other main second business line is it has an electronics components business, which it basically provides photo masks for advanced semiconductor manufacturing. So people like Taiwan Semiconductor, Intel would be its customer base. So it has two main business streams, but the one we really like for its the potential to have a positive non-financial outcome on people's lives is like both aspects, but we particularly like the eyeglass technology. We know that the provision of good eye care is closely linked to rising job prospects, it's rising household incomes. And so they work in partnership with a number of NGOs to provide affordable eye care into the emerging markets, as well as providing a very high quality product into the Japan and other developed markets around the world. We think eye care is it is a growth area. We live in an aging world. People need more eye care, and Hoya, it's an excellent company, very profitable, strong free cash flow. Lots to like about it, but whilst its governance is good, it is quite early in its ESG journey, and we have used our relationship with them to really seek accelerated improvements around their understanding of sustainability. It was really nice to see, we had some conversations with them and said, you really need to set up an in-house ESG committee that's dedicated to building out this ESG into your business strategy. Sometimes it's hard to make the connection between our conversations and actions of the company. But when we had that conversation, they posted only 3 weeks later a stock market notification back in Japan that they were setting up their first ever ESG committee. So we could feel rightly quite proud of that. Now, I'm sure other investors were having similar conversations. We've also pushed them to be more explicit around their water intensity, water utilization, around their carbon targets, because of course they're making glass lenses that's quite carbon intensive. One of the things they've said is that although they have a lot of facilities in Asia, it's quite hard to get hold of the renewable power, because renewable power is more built out in developed markets. So we're working with them to try and work through these issues, and they've made some really nice commitments in terms of their environmental targets, and we think they can be a trailblazer within Japan, which is a bit of a laggard in terms of their ambition.
That's really good, especially on the engagement piece. I mean, we have clients that walk through the door, they're looking to invest ethically. the case study you've just given there is a perfect example of the type of thing that conscientious investors want to see happen. Okay, we move on to third example, Schneider Electric. Now, Schneider Electric are known to be at the forefront of doing things in the right way, and they've won awards that often been. I mean, I'm going to steal your thunder here, but tell me more about Schneider Electric and why they're in your portfolio.
Okay, well, so Schneider Electric, it's a French industrial business, which is well regarded in terms of global ethical and responsible and sustainable funds, and rightly so. It's really exposed to two structural growth markets. One is around energy management and energy efficiency. The other one is around industrial automation. Now, we didn't own Schneider Electric until the pandemic because we thought it was a great business, but a little expensively valued. Then the pandemic hit, the world stopped, the share prices fell very, very heavily around the world. And Schneider Electric was a great company that we picked up because we liked what they did. Energy efficiency is absolutely central to the world we live in today. They're very closely connected to carbon emission reductions for buildings. We know that buildings account for around 1/3 of world's carbon emissions. So they work with construction companies and building operators to reduce heating loss and providing more energy efficient solutions. Also, very closely linked into data center management. Data centers, we know, are hugely energy intensive, and so they work with them to come up with sustainable grid solutions to reduce the data center carbon footprint. And they're very, very closely linked into electrification. We see electrification trends all over the world. We think that's a very persistent trend. They are indeed also involved in the rollout of electric network upgrades, with everybody shifting towards EVs, electric vehicles. We need to see more infrastructure renewal. And Schneider Electric, they are a French company, but they're global. They have a footprint around the world. They are in the lead. They are absolutely in the vanguard of industrial companies coming up with energy efficient solutions for a whole range of industries. So, we think they're very ambitious. They're very close to exciting growth markets like China and India. They have an absolute relentless focus on costs and expanding their margins as they move into more software areas of the market, more recurring revenues. And, we believe the valuations continue to be very supportive. It's a European business. People are worried about European recession, the proximity, the impact of the Russian-Ukraine war, and we think the business is highly attractively valued at this price, and it's in our top 10 holdings.
Fantastic. Yeah, I think they're a blueprint for many industrial businesses. So I like the fact you've got it in your portfolio. Okay, we're going to move on a little bit now. We've spoken a lot about the positive elements of this fund, which I think is a great fund. But as is the way, the nature of the beast, being a financial advisor, when I talk to clients, I say, this is the good elements, these are potentially bad elements. We still think you should go for it, and this is why. It's going to play devil's advocate with you here. I want to know whether your fund suffers at all, because it is quite a large fund. So I think I've worked out something like 25-30 million would be your average holding in any one company. Do you see the odd business that comes through, multi-million business, that you think, well, I'd really like to invest in that, but in practical terms, it's just a bit too small for our fund, and then you miss out on some potential good returns and good growth and good funds. So how would you answer that? Is this fund too big on some occasions?
That's an interesting question. Absolutely not, in our opinion. The absolute beauty of being a global fund is that we can invest anywhere. As many of your watchers will know, we have always been an all-cap strategy, an all-cap fund. Indeed, we are and have been for the 10 years that I've run the fund. We've been structurally underweight global mega caps. So we are at our happiest investing sort of in the mid to large cap space. Companies that sit within the $10 to $100 billion market cap range. That is our absolute bread and butter. We see a huge opportunity, a huge amount of innovation. Occasionally, there are some small cap names that we, we acknowledge to be fantastic businesses, but we think it would be a little imprudent to take a position because of the liquidity concerns. We know for our investors liquidity is important. We don't want to jeopardize that. But honestly, the things we pass up are very few and far between, because we have such a huge opportunity set to look at, and plenty of liquid businesses to buy, and businesses that are really growing in a very sustainable, purposeful manner. So really not a problem for us.
That's good. I like your candid response. So that's good to see. Okay, I think we're more or less there. I'll just ask the question, if I may, that if you think there's anything that we perhaps could have covered today that we haven't done, now is your opportunity. Do tell me. Is there anything else you think the audience watching this needs to know?
Well, I guess I'd just like to point out that, March 2023 is going to be the 25th anniversary of this fund's existence as a global equity fund. It's a highly specialist, responsible global equity fund. And we know over the last couple of years, there's been a real race into the space, a real drive to look at sustainable investments. But that's always been important to us. We've done it for over nearly 2.5 decades. And what's interesting is that, we continue to be ambitious with the fund. We continue to try and push the boundaries of what makes a responsible fund a responsible fund. And, quite recently, we were lucky enough to pick up a Best Sustainable Global Equity Fund Award at the Investment Week Awards 2022. And one of the things they picked up on is that ambition to keep improving, but also a commitment to be transparent, to really have an open dialogue with our investors. And whilst we certainly don't get it right all the time, we have that commitment. We welcome the feedback, and we'll keep trying to reveal everything that we do and give our investors greater insight into the financial returns we're trying to drive for our long-term investors, but also those positive non-financial outcomes too.
Fantastic. That's really good. Okay, I think we'll wrap it up here, Jamie. So thank you for your time. Before you go, just to re-emphasize to anyone that's watching this, if you've got this far through, just to remind you that this is for information only, this video. Do not invest based upon what you've seen here. Go and see a professional. Come to Good Green Money, speak to one of our advisors or one of the other ethical advisors out there, because although this is a great fund, it might not be right for you. So take heed, read the warning notices that come after this. And the final thing to say is, if you like what you see and you want to be kept up to date with other videos in the future, do subscribe to our YouTube channel, and then you'll be able to know when they come about. So there we are. Thanks again, Jamie. It's been fantastic, really insightful, very useful, and thank you very much for your time.
No problem. Great to talk.
And you. See you soon.